Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey, guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. And, guys, you are in the right place at the right time because I am going to embarrass myself a little bit. I am going to sound a little bit like Archie Bunker, a little bit like Clint Eastwood. I'm going to tug my trousers up so that my belt loops are just below my chest. I'll be wearing my belt buckle like a necklace. I'm going to sound like that old man who's out on his lawn with the garden hose squirting the kids saying, "Get off my lawn." I'm going to date myself here. I'm going to take it back for a minute. Guys, I'm wound up because I've got an article in my hand that was released this week that I think has everybody just confused and frustrated. And yes, there's merit to all of the data in here, but I just think it's slightly misleading, and I want to shed some light on the other side of it. So we're going to dive into that here in a second. Yes, housing affordability is under pressure. However, I do not think it is as bad as this article alludes to, nor do I think it affects as many people as you would assume it does by reading this article. So we're going to dive into that. If you've got questions or comments, just call or text 855-462-7292. That's 855-462-7292. That's the Anytime Hotline. Jen is womanning the hotline, and she will get your questions on the air. Or if you prefer, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. There's a big orange button in the middle of the screen that says Get Your Questions on the Air. Click that button, type your question in, it'll pop up on our end, and Jen will read it on the air. MrMortgageRadio.com. But hey, let me dive in. This article was published Wednesday morning, written by Tim Mullaney on CNBC.com, and it starts off saying, man, guys, get ready for this. Ready? I need some dramatic music, and I don't have any loaded in the board. As mortgage rates reached a 23-year high last week, the cry went out across markets and social media. Is housing affordability dead? Has a version of the American dream, homeownership, kids, and backyard barbecues, died with it? My God, Mr. Mullaney, that is, hold on. What a well-written, scare the poop out of everybody headline. Man, oh man. And the article was fantastic, packed with a lot of good data. But my point is, I think you'll see it a little bit differently in one moment. So the spirit of the article is, what would it take for homeownership to become affordable again? And they talked about a $400,000 median mortgage amount. And at 3% interest rates, 50 million Americans could afford a mortgage payment, a $400,000 mortgage. But now it's just 22 million. And it says what would have to happen for that to become affordable again. And one of three things, preferably a combination of these three, but one of three things need to happen. Depending on appreciation, rates would have to fall to as low as 3.19%, or if appreciation goes flat, in the higher threes, 3.55%. Well, guys, rates aren't going back to threes. And Lawrence Yun says that in this article. We'll be lucky to see 5. And if you don't follow Lawrence, he's the chief economist for the National Association of Realtors. Brilliant dude. He says we'll be lucky to see 5. So the chances of rates falling to the threes and making homes suddenly affordable again, that's not happening. Then the article said, well, the median price would have to fall to $265. Well, we're at $410. So it's unlikely that we're going to see that kind of haircut certainly without the supply coming to the market. And we're going to talk about that here in 1 second because that infuriated me in this article. And lastly, salaries would have to jump by 63%. Well, I don't know about you, but I don't know anybody getting a 63% raise. So again, unlikely. Now, guys, it wasn't too long ago, maybe a month ago, we did a show and I titled the podcast episode was titled Housing Crisis, Fact or Fiction. If you missed that episode, at least listen to the first 8 minutes because it'll tie perfectly into what we're talking about today. And you can find that at MrMortgageRadio.com at the bottom of the page. All of the back episodes are there. Okay, 2/3 of the population on average in recent history, going back to the 50s or 60s, have owned a home. Well, that's where we are today. So this idea that suddenly no one can afford a home is a little bit misleading. And it's only new home buyers, first-time home buyers, because if you own a home, it's highly likely that you've got a ton of equity. So if you sell, you can afford to put a bigger down payment down. You could afford to buy your interest rate down. So this idea that real estate is out of reach for everybody it's a farce. It's untrue. People have so much equity. A double-digit percentage of the population don't even have a mortgage. A lot of people could sell and pay cash. There's still a tremendous percentage of the population that can comfortably participate. So what we're really talking about is first-time home buyers, and that's where my mind went. Guys, if you've listened to the show for any length of time, you may have heard me tell this story. But in 1991, I bought my first home. I was a very young man. I was like 3. No, I'm kidding. I was in my early 20s and given some great advice by an older guy who said, hey, you got to build equity. So I bought a $64,000 house with a 10% interest rate, and we had 2.5% appreciation. So arguably backwards, right? Compared to where we have been recently. However, it's paid great dividends over time. I paid my principal down. I sold that house. That equity, not my savings, not my 63% increase in my salary, not a huge dip in interest rates or a huge price reduction. That equity allowed me to go buy the house I wanted in the really nice neighborhood, right? But 64,000, don't forget that number. The median, I did the research. I went to the HUD website. I went to the Federal Reserve website. In 1991, the median home value in this country was $120,000. Whoa, wait a minute. I bought a $64,000 house. I didn't stomp my foot and say, I want the median. I can't afford the median, so lower the rate or lower the price. I bought what I could afford, and I didn't know any better. I was tickled to get it. And it was in a mediocre neighborhood. It was a 2-bedroom, 1-bath, no garage, detached laundry room, and I couldn't be happier. Why? Because the American dream isn't homeownership. The American dream is the opportunity to build equity. It's the stability. It's the hedge against inflation. It's the fixed monthly mortgage payment. And it's the foundation for some financial freedom as you build equity. So my point in sharing that is we just went through that article and they said if the median price would fall from 410 to 265, then everybody could participate again. How about if everybody just swallowed their pride and started at 265 instead of 410, if we bought what we could afford instead of what we want and get past this entitlement era that we live in where everybody wants their life to look like Instagram. So, all right, guys, that's my old man on the front lawn moment. I'm going to shake it off. And on the other side of this commercial break, we'll be back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of 3 things will happen. 1, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or 2, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or 3, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show, and I'm laughing because Jen was calling me Archie Bunker during that commercial break. Hey, do you know that Archie Bunker and Edith were in their 50s? Not the actors, but the couple they portrayed were in their 50s because Gloria and Michael were in college at the beginning of that series. So, man, 50 doesn't look like that anymore, right? We saw Jennifer Lopez at 50-something dancing around the Super Bowl, and I don't know. I'm in my early 50s, and I still surf and ride motorcycles, so I don't feel like Archie Bunker, although in that opening segment I might have sounded like Archie Bunker. I guess where I was going with all of that is it's never, ever, ever as bad as the news says. I mean, I remember when the news came on and basically just gave you the information with no opinion or drama behind it. And now I feel like it's more opinion than fact. So I appreciate everybody letting me have that moment. And I hope that was interesting. If you've got questions about it, let's dive into it. And speaking of your questions, call or text those to 855-462-7292. That's 855-462-7292. That's the Anytime Hotline. And as always, Jen is in control, womanning the hotline. She'll get your questions on the air. You can shoot those to her via email, but it's no longer email. Just go to mrmortgageradio.com. That's mrmortgageradio.com, and there's a big orange button in the middle of the screen. Click that button, type your question in, and it'll pop up right here on our end. So anyway, Jen, and your questions are ready. So I feel like I kicked an ant pile over there. Let's see what we have. Hey, Jen, go ahead and throw me that first question.
Amanda is asking, my husband works full-time and I run a small online store. Can we use my income too when applying for a mortgage? I'm unsure because I work only around 3 hours a day.
Hey, Amanda, this is a really, really good question. So I know where the confusion lies because you mentioned you work 3 hours a day. So in a lot of people's mind, they're going to treat that as a part-time job, but you really are self-employed. It just takes you 3 hours a day to run your business. So as long as you're claiming that income on your tax returns, how long it takes you each day is no longer relevant. That's only if you are receiving a wage from an employer and if you're paid by the hour in most cases. So that 3 hour a day to run your own business. And man, congratulations. I want to figure out how to do that. I'm sure it's not easy, but my point is, as long as you're claiming that income on your tax returns, then the time it takes you during the day to perform your duties is no longer relevant. We can use that income. And oftentimes we're looking for 2 years of self-employment work history. In some cases, it could be as little as 1 year, but if it's 2 years, you have a better chance. So great question though. Guys, if you're wondering how you can use part-time income when qualifying for a mortgage, if you just work 3 or 4 hours a day, but you did it consistently for 2 years, and let's say you work 4 hours a day. So here's the perfect example. I had a woman who worked at a daycare. She did a 4-hour shift 5 days a week, but she did it every week, every day. So she had a 2-year work history with 20-hour weeks, and we were able to use that income. So part-time income needs to be consistent, but this is a different circumstance, and it would fall under those self-employed income guidelines. So great question. Hey, Jen, throw me another one.
Merlin sent this question. I'm looking for a duplex as my first rental property investment. What are the primary differences between financing a duplex versus a traditional single-family home? Does it help if I move into one side?
Hey, sorry about that, Jen. Hey, Marlon. That's a really good question. Now, you threw me there at the end because if you're just buying a duplex or you're buying a single-family home as an investment property, there's not any difference in the mortgage. You're buying it as a rental. There's factors that go in using the rental income for the property. The loans are very, very similar. Now, the second part of your question, if you move into one unit, now that qualifies for primary residence financing. So with an FHA loan, you could put as little as 3.5% down and buy that as your primary home. And with that new rule change with conventional, you could put as little as 5% down. So moving into it changes the loan program, but the loan program is the same whether it's a single family or up to a 4-unit. I hope that helps. And guys, a lot of people are doing that. You'll hear the term house hacking. A lot of people are house hacking where and it's because of prices. They'll move into one unit and rent the other unit out. So great question, Marlon. Appreciate that one. Hey, Jen, can we squeeze in another?
Emily emailed this. We are first-time home buyers and have stumbled upon a foreclosed property that seems like a good deal. What should we be aware of mortgage-wise when considering buying a foreclosure?
Okay, there's a lot to this question. So if you're buying a foreclosure that's already actively for sale and the property is in habitable condition, then you're not going to have any mortgage restrictions as long as, everything's there. If it needs repair, it might be eligible for something like an FHA 203K loan where some of the repairs can be rolled into it. If it's a home that's not already actively for sale and it's going to foreclosure auction, that's a different animal. Most of the time, you're going to need to be prepared to pay cash for that property. So I would need to know a lot more because it depends on where it is in the cycle of foreclosure. That's going to dictate what type of financing you would be eligible for. So if you're buying it at auction, that's one thing. If it's actively listed for sale as a foreclosure, like last week we talked about HUD Home Store as a great resource for FHA foreclosures. Oftentimes with the HUD Home Store properties, they're eligible for mortgage financing, and they'll build that into the timeline for you. If it's an auction property, you're usually paying cash at the time of auction. So I hope that helps. I'd love to talk to you in a little more detail. There's a couple things I'd like to clarify so I can give you a better answer, but I appreciate that one. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. On the other side of this very short break, we'll be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Man, we've had some great questions so far. If you've got questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. I sound like I'm reading that so slowly because I have a tendency to race through that, so I've got it written out in front of me. Anytime Hotline. hotline, slow down. 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. You can't miss the big orange button in the middle of the screen that says get your questions on the air. If you click that button, type your question in, it'll pop up on our end and Jen will read it on the air for you. All right, speaking of Jen and your questions, I'm going to throw it her way for another one. Go ahead, Jen.
Josh is wondering, I've heard talk about the debt consolidation loans and wonder how we calculate whether refinancing our low rate makes sense. How do we calculate the average rate of our loans?
Hey, Josh, that is a great question. And we built a calculator just for you. If you go to recrefi.com, that's recrefi.com. There is a debt consolidation calculator on there. And you can enter in all of your current debts, your current interest rates, your current payments, and then what a mortgage refinance would look like as far as a monthly savings. Or if there's no savings, it'll tell you that too. So check out recrefi.com. And I think when you say average interest rates, you're talking about a blended rate calculator. And if you Google that, there's a ton of them out there. But when it comes to evaluating if it makes sense, for most people, they're just looking at their monthly expenditures. So if a debt consolidation loan will save you, X number of dollars a month, then you can determine how long it'll take you to break even on the closing costs. And then from there, factor if it makes sense. And if you need to know how that calculation works, take the cost of doing the refinance divided by the monthly savings, and it will show you how long until you break even on the monthly savings. So if it's, $10,000 and it's $500 a month, it's going to take you 20 months to break even. So if you need help with that, just give me a call and I can run your actual numbers for you. I'd be happy to do that. Anybody out there, if you need some help with that. But a good jumping off point is recrefi.com. So I hope that helps. I appreciate that. Hey, Jen, do you have another question?
Sarah is asking, we are first-time buyers and have been saving for a down payment. Is FHA our best option if we don't have the 20%? The rates seem a little better.
Hey, Sarah, great question. And yes, you did notice the rates on the FHA loans are a bit better than conventional. So for a lot of people in the first-time homebuyer category, that FHA loan gives a lot of flexibility. Whether it's a lower credit score requirement than some of the conventional programs, whether it's a higher debt-to-income ratio, there's just a little more flexibility in the underwriting guidelines. And then the obvious one is the interest rate. Now, here's the big difference with the conventional loans and FHA loans. If you put less than 20% down with a conventional loan, you're going to be required to have mortgage insurance. You'll hear the term PMI or MI or MIP, depending on the loan program. FHA also has a mortgage insurance component. The big difference is that with conventional, once your loan balance reaches 78% of the value of your property, you can have the mortgage insurance dropped. So if homes keep appreciating and suddenly your loan balance represents 80% of the value or less, or 78% to be precise, you can have the mortgage insurance dropped. With FHA, you can't do that. The only way to drop the mortgage insurance component with an FHA loan is to refinance it into a conventional loan later. That's the biggest difference. The interest rate is a little bit lower. The mortgage insurance premium for FHA can also be a bit lower. So from a monthly payment standpoint, the FHA loan might be the better choice, but just know about that mortgage insurance component. So I hope that helps. If you need a deeper explanation, just give me a call off the air and I'll walk you through it. I appreciate that one. Hey, Jen, let's get another question in.
Tim sent this. I'm interested in the idea of house hacking by living in one unit of a multifamily property and renting out the others. Is the landlord loan our best option for this kind of investment?
Hey, Tim, great question, my man. And you picked up on that. We were just talking a little earlier about house hacking. And guys, that term is just, internet slang. You're buying a multi-unit property, either a duplex, triplex, or fourplex. You're moving into one of the units, making it your primary, which now makes that eligible for, with FHA, as little as a 3.5% down payment. You get all of the preferences of a primary home purchase, a slightly lower interest rate, less down payment required. Now, here's the thing, my man. The landlord loan will not work in this example. The reason is, with the landlord loan, that's only for investment property. If you're going to move into one of the units, that no longer meets the requirement. And there's an affidavit in the loan package for the landlord loan, which is a variation of the DSCR loan, the debt service coverage ratio loan, if you hear that term. There's a document in the package that you sign that expressly states, I will not occupy this property. So you'll want to go with a more traditional mortgage route if you intend on house hacking your way to an investment property. If you're just going to buy it as a straight investment and not live in it, the landlord loan is a fantastic option. But the moment that you make one of those units your primary, then you're no longer going to meet the requirements for the landlord loan. Great question, though. If anybody has questions around that, whether it's that house hacking strategy or the landlord loan, please give me a call and I will walk you through it. Hey, Jen, let's squeeze in another question.
Natalie used the website for this one. Okay, I've heard you mention an option for someone who can't get an equity line. Where do we find more information? Thank you. Hey,
that was Natalie. Man, another great question answered with recrefi.com. So in addition to the loan consolidation and the debt reduction calculator, that's the loan program that a lot of people who go the equity line route only to be denied because of either credit score, loan to value, LTV, or the debt to income ratio. With the Rec Refi, the debt to income ratio calculation is the biggest difference with the equity line. And oftentimes, if the equity line was no, the Rec Refi may be a yes. So check out recrefi.com. That is Rec Refi, and Rec stands for Reduce, Eliminate, and Consolidate. It's the debt consolidation loan program, recrefi.com. So I hope that helps. But hey guys, you hear the music, you know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you want your questions or comments on the air, just call or text 855-462-7292. That's 855-462-7292, affectionately known as the Anytime Hotline. 855-462-7292. Jen is womaning the hotline. She'll get you on the air, or You can shoot your questions over to her by visiting mrmortgageradio.com. That's mrmortgageradio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. If you click that, there's a little form that pops up, and Jen will see your questions on her screen. That's mrmortgageradio.com. And if you're curious to see what this mug looks like in person, I definitely have a face for radio, but I'm on the page too, mrmortgageradio.com. Hey, but we've had some really, really good questions. I want to keep them rolling because we have a few stacked up back there. So Jen, go ahead and throw me another question.
Ben sent this text. We are looking at properties to invest in and rent out. The best deals are out of state. Is this even an option?
Hey, Ben, great question. Yes, you can use the landlord loan across state lines. So yes, you can buy out-of-state investment properties with the landlord loan. And a lot of people are doing it. It was quite interesting. There was an article released this week, and we did not go into it, but we might touch on it next week about which markets it's cheaper to rent than buy in and which markets it still makes a lot of sense to buy versus rent. And in those markets, people are using the landlord loan to buy rental properties because it's cheaper to own it than rent it. So there's still a lot of positive cash flow in those circumstances. So great question. Yes, you can cross the border with the landlord loan. Hey, Jen, toss me another one.
Kelly has this question. Can you please explain the difference between a 3-2-1 buy down and an adjustable rate mortgage? They seem like the same thing.
Hey, Kelly, that is a great question. And a lot of people get super confused by that because they're the same in one aspect in that the payment will change at different increments. So let's start with the 3-2-1 buy down because it's super popular right now. The way that mortgage program works is, and it's the seller or the builder in this instance with the 3-2-1 buy down. They're paying a fee on your behalf, closing cost contribution or builder contribution, that buys your payment down to an effective interest rate of 3 full percentage points lower for the first year. So let's say interest rates were 7.5%. Your first year's payment would be based on a 4.5% interest rate. That's 3% reduction. Your second year, 5.5%, 2% reduction. Third year, 6.5%, which is just 1% reduction. Then it goes back to 7.5%. That's a 3-2-1 buy down. An adjustable rate, you'll see like a 5-1 arm. That means it's fixed for 5 years and then it adjusts every year thereafter. So you're getting a fixed period of time with the adjustable rate mortgage, and then it's going to adjust to the market based on a pre-disclosed index and margin. And that's where you want to pay close attention so you can get an idea. And there's a ceiling and a floor. So there's a max adjustment up and a max adjustment down. But then that loan will adjust every year. Sometimes it's 6 months, but most often it's a year. Every year thereafter. So your loan will adjust to whatever market conditions that there are. That's a true adjustable rate mortgage. The 3-2-1 buy down is a temporary payment reduction. And then once it resets to the starting rate, if you will, it stays there for the remaining, 27 years. So I hope that helps. And you can go to 321buydown.com, all typed out. I just put that up the other day as an explainer because so many people are confused by that. 321buydown.com. It'll walk you through exactly how it works. But brilliant question. And you're not alone with the confusion around that. Hey, Jen, throw me another question.
Jimmy sent this. I've heard about no income verification loans. Are these a viable option for debt consolidation, especially if I'm between jobs?
Hey, Jim, that's a great question, my man. I wish, but there's not a no income verification debt consolidation loan, and certainly not if you're currently unemployed. So it's probably not what you wanted to hear. Some people get the no income verification component of the landlord loan confused. But the income verification in that loan program is based on the rental income or the projected rental income of the property. If you've got a very specific scenario where you've got a ton of equity or a ridiculously high credit score, there might be an opportunity for a short-term loan with a private investor. But that being said, by and large, there's not a no income verification debt consolidation loan program that I'm aware of. I hope that helps. If you need to have a conversation about a specific circumstance, just give me a shout and I'll be happy to help if I can. Great question though. Thanks. Hey, Jen, throw me another one.
Laura sent this through the website. I know there would be more closing costs, but other than that, what is the downside of a debt consolidation loan now and then a refinance to a lower rate later?
Hey, Laura, this is a really, really good question. And you hit the nail on the head. The downside is the additional closing costs, because every time you do a refinance, those closing costs eat up a little bit of your equity. But this is the harsh reality a lot of people are faced with. They held on to that super low interest rate. They ran up their credit card. And I'm not saying this is your circumstance. This is just what we're seeing. And there's articles every week and data sets every week supporting this. Credit card debt is at an all-time high. Credit card interest rates are deep in the 20s. And equity line interest rates are in the teens. And people are thinking, my God, my debt load is becoming truly burdensome. And yes, that super low mortgage rate is attractive, but I'm getting buried everywhere else. So a lot of people are in this circumstance where they're just going to bite the bullet and do a debt consolidation refi, take the pressure off, save that monthly savings, and you can either apply it to principal or stick it in the bank for a rainy day. And that's basically what we're seeing people do right now because there's so much uncertainty around the economy. And then if rates pull back in the future, they'll do a rate and term refi. So the downside is a second set of closing costs. We have what we call a strategic refinance program where we are waiving as many of those closing cost fees that we control, but there's a certain percentage of costs you can't control. So great question. And that is the biggest downside, is the second set of closing costs. So I hope that helps. And guys, a lot of people are in this circumstance. Another thing we're seeing people do is they're waiting too long. We had a call on the air a couple weeks ago where the caller had lost her job. And at that point, we just had a question or two ago about a no income verification loan for debt consolidation due to currently not working. If you're in that situation, then you're often left with no choice because without the job, you're not going to qualify for any type of debt consolidation refi. So I'm not saying it's right for everybody, but as this inflationary cycle that we're in puts more and more pressure on the consumer, and with the interest rate environment that the Fed is putting us in and likely to continue at very least holding, a lot of people are faced with this tough decision. So great question. I'm sorry that you're in this boat. If you want to walk through your specific scenario, I'd welcome the opportunity to jump on a call with you. But yes, you hit the nail on the head. The second set of closing costs is the big downside. Oh boy, I hear the music. Hey, before we go though, if you are out there and you are dealing with these circumstances and you're wondering, would a debt consolidation refi make sense? How do I make the landlord loan work if I'm crossing state lines? Where is that calculator Mark was talking about? Guys, just head over to MrMortgageRadio.com. Everything's there. Give us a shout, 855-462-7292. I'll be happy to help you any way I can. If you're listening to the show, that means my team is in your area too. Guys, we're nationwide, everywhere except New York. So if you can hear my voice, we could be your choice. But with that being said, Jen is back there trying to land an airplane. She's waving her arms around trying to get my attention. It's time to wrap it up. Guys, man, we've come to the end of another week here at the Mr. Mortgage Show. I don't know where the time goes, but I love spending this time with you each week. If you need us when we're not on the air, head head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Everything's there. MrMortgageRadio.com. Otherwise, guys, Jen and I will be back next week right here, same time, same station. Have an amazing week.